Merry Christmas. While you're sitting on the couch with your family checking a silver chart that looks frozen and peaceful, the real market has already moved on. Today, December 25th, 2025, while Western markets are closed, silver is already trading near $80 in Shanghai, not on a chart, in the physical market. And that creates a fact that changes everything. An arbitrage gap of nearly $8 right now, with a clear structural path to $12 or more before year end. And if you think nothing happens during the holidays, I need to warn you. You have just entered Ghost Week, and Ghost Week is not quiet. It is a vacuum. A liquidity vacuum where normal market rules don't apply, where small orders create massive moves, where gaps don't close, they explode, and where the price you see on your screen becomes completely disconnected from the price being paid in the real world. In this emergency breakdown, I'm going to show you why Shanghai at $80 is not an outlier, it's leadership. I'm going to explain how Ghost Week turns manageable gaps into explosive dislocations. I'm going to prove why a $12 arbitrage gap is not hype, but mathematical inevitability given current conditions. I'm going to detail the mechanics of what happens when Western liquidity vanishes while Eastern demand accelerates. And I'm going to give you the 5 signals to watch in the next sessions to confirm this in real time. Take a breath, because what comes next is not comfort, it's a warning. The Western markets are closed, the skeleton crews are manning the desks, the algorithms are running unsupervised, and Shanghai is setting a price that Comex can't challenge. This is the story of Ghost Week, and why the next 7 days might reshape the silver market permanently. Let me start by defining what Ghost Week actually is, because if you don't understand the mechanism, you won't understand why this is so dangerous. Ghost Week is the trading window from December 26th to January 2nd. This is when senior risk managers disappear, market makers pull liquidity, institutional desks flatten exposure, and markets are left to skeleton crews and algorithms. This does not reduce risk, it removes shock absorbers. Think of the market like a frozen lake. On a normal day, the ice is thick, big orders hit, and the price barely moves. The depth absorbs the impact. Market makers step in, liquidity providers fill the gaps, institutional traders smooth out the volatility. But during Ghost Week, the ice becomes paper thin. A single large order doesn't move the price, it teleports it. Because there's no one there to absorb the shock, no one there to provide the other side of the trade, no one there to prevent the gap from opening. That's how gaps are born, not gradually, violently. And once a gap opens in thin liquidity, it doesn't close politely. It either snaps shut in a violent reversal, or it stretches wider until something breaks. Now let's look at the data today. It's simple and brutal. Shanghai approximately $80, Comex approximately $72, gap approximately $8. This is not a temporary dislocation. This is a structural divergence, and it's happening at the exact worst time. When Western markets can't respond, when liquidity is at annual lows, when the people who normally manage risk are on vacation. Rule number 1 of commodities. In surplus markets, paper sets the price. In shortage markets, physical sets the price. Shanghai trades delivery. Comex trades promises. And when the two diverge, one thing always happens. Metal flows toward the higher price. That creates a magnet. The wider the gap, the stronger the arbitrage, the faster vaults drain, the weaker paper control becomes. Once Shanghai accepts $80 stops being resistance and becomes reference. It becomes the floor, not because of technical analysis, because of physical reality. Industrial buyers in Shanghai are paying $80. That's the real price. Everything else is fiction. Now here's what makes this critical. The gap we're seeing isn't closing, it's widening. And during Ghost Week, widening gaps don't self-correct, they accelerate. Because the mechanisms that normally close gaps aren't functioning. Let me explain the normal arbitrage process and why it's broken. Textbooks say arbitrage closes gaps. Reality today says arbitrage is increasing stress. Why? Because metal cannot arrive fast enough. Vaults are already depleted. Asian industrial demand is price inelastic. Here's how it's supposed to work. Trader sees $80 in Shanghai and $72 in Comex. Trader buys Comex at $72. Trader ships metal to Shanghai. Trader sells at $80. Profit is $8 minus shipping and insurance, probably $5 net. That's huge profit. Risk-free. So thousands of traders execute this simultaneously. Their buying in Comex pushes Comex up. Their selling in Shanghai pushes Shanghai down. The gap closes within hours. But that's not what's happening. Here's what's actually happening. If Comex drops, the gap widens. Arbitrage bots buy instantly. Physical disappears. If Comex rises, paper chases. Shanghai reprices higher. The gap persists. This creates a rare condition, and the gap becomes an elastic band, not a bridge. And during Ghost Week, elastic bands snap. Why is this happening? because Western vaults don't have enough physical silver to supply the arbitrage. Comex registered inventory is below 70 million ounces. That's the metal available for immediate delivery. But the arbitrage demand, the amount of metal that traders want to move from west to east to capture the 8 spread, is in the hundreds of millions of ounces. The supply can't meet the demand, so the gap doesn't close. It persists. And as it persists, it creates more stress. More buying pressure in the west, more upward pressure in the east. The loop reinforces. In part 2, we're going to explain why Ghost Week specifically amplifies this dynamic, because thin liquidity doesn't just make moves bigger, it makes them unpredictable, violent, and impossible to control. Stay with me. We're going into the mechanics of the vacuum. If you're just joining us, we've established that Shanghai is trading near $80, while Comex shows 72. That's an 8 to arbitrage gap. And we've entered Ghost Week, the period from December 26th to January 2nd, when liquidity vanishes. In part 1, we showed the gap and the broken arbitrage. In part 2, we need to understand why Ghost Week turns manageable gaps into explosive dislocations. Because this isn't just about having less liquidity, it's about what happens when the normal stabilizing forces disappear. Let me walk you through what normal market structure looks like. On a typical trading day, you have multiple layers of participants. Retail traders placing small orders, algorithmic traders providing liquidity, market makers maintaining two-sided markets, institutional traders balancing large flows, risk managers monitoring exposure, senior traders making strategic decisions. Each layer provides a cushion, a shock absorber. When a big order comes in, these layers absorb it. They spread the impact across multiple participants and timeframes. The price moves, but smoothly, gradually, predictably. But during Ghost Week, those layers disappear. Senior risk managers are on vacation. They're not monitoring. They're not making decisions. Market makers reduce their exposure. They don't want to be caught holding risk over the holidays with no one to manage it. Institutional desks flatten their books. They close positions. They go to cash. They wait for January. What's left? Skeleton crews, junior traders with strict limits, and algorithms, automated programs running unsupervised. This creates a fundamentally different market structure. Instead of layers of liquidity, you have gaps, voids, price levels where there are no bids or offers. And when an order hits one of those voids, the price doesn't move gradually. It jumps. It gaps. It finds the next available liquidity, which might be $2 or $3 away. Now combine this with the Shanghai $80 situation. Shanghai is trading, fully active, no holiday. Industrial buyers are bidding. Arbitrage bots are running. Physical demand is constant. But Comex is operating with skeleton crews, reduced liquidity, limited ability to respond. This creates asymmetry. Shanghai can move freely. Comex can't respond effectively, and that asymmetry is how gaps expand. Here's the specific mechanism. Shanghai opens on December 26th at $80. Strong bid. Industrial buyer needs 500,000 ounces. Places order. Price moves to $80, $50. Now, in normal conditions, that move would trigger responses in Comex. Traders would see the Shanghai move, they'd buy Comex futures, they'd start closing the gap. But during Ghost Week, those traders aren't watching. The algorithms might react, but they're programmed conservatively during low liquidity periods. They don't chase. So Comex stays at $72. The gap is now $8.50, not $8. It widened. And as it widens, more arbitrage bots activate. They see the bigger spread. They try to execute, but they can't get the physical metal. So they just push Comex higher in thin liquidity. Comex jumps from $72 to $73.50, not because of fundamental demand, because of algorithmic arbitrage in a thin market. Now the gap is $7. It narrowed. But Shanghai sees Comex rising and interprets it as confirmation. Another industrial buyer steps in at $80.50, then $81. Comex is at $73.50. Gap is back to $7.50. This is the elastic band. It stretches, it contracts, but it doesn't break. And during Ghost Week, this process happens with violence, because there are no humans smoothing it out, just algorithms reacting to other algorithms. And industrial buyers, who don't care about the noise, they just need metal. Now here's why this matters for the $12 gap thesis. Because the worse Comex performs, the wider the gap gets. Let me show you the math. Current gap is $8. Shanghai $80, Comex $72. Now imagine Comex drops. Maybe a large fund liquidates a position. In our last segment, we discussed Ghost Week and how it strips the market of its usual defenses, creating the perfect storm for extreme price moves. Now, in part 3, we're going to map the specific mechanical path to a $12 arbitrage gap between Comex and Shanghai. This isn't speculation. This is a mathematical process that's already in motion, and all the conditions for a major acceleration are falling into place. So, how do we get to a $12 gap? It's not about wishful thinking. It's about understanding that given the current market structure, this is a plausible, almost predictable outcome. 3 core conditions need to be met, and I'm going to show you why all 3 are already locked in. Condition A is that Shanghai holds its price at $80 or higher. This is already happening. Industrial demand in China is relentless. We're talking about solar manufacturers, electronics producers, and battery makers. Their production lines don't stop for Christmas. Chinese New Year isn't until late January, so their demand for silver is constant right through Ghost Week. And for them, $80 silver is still far cheaper than shutting down a multi-million-dollar factory. So, condition A is established. Shanghai will hold that $80 floor. Condition B is that the paper market, Comex, fails to catch up quickly. Ghost Week guarantees this. With skeleton crews and thin trading volumes, Comex can't respond effectively. Even if a few traders wanted to push the price up to 80 to match Shanghai, they can't do it smoothly. They'd have to gap the price up, which triggers a whole new set of problems. Stops getting hit, volatility exploding, and risk managers getting angry calls on their vacation. So, Comex will likely drag its feet. It might grind its way to $75 by New Year's. But while it's doing that, Shanghai could already be moving to 82. The gap doesn't close, it just shifts higher. Finally, condition C, no major physical sellers emerge to close the gap. The vault data tells us they won't. Comex registered inventory is already critically low, barely enough to cover 2 months of global industrial demand. There's no strategic reserve or government stockpile waiting to be dumped on the market. The physical metal simply isn't there in the quantities needed. And even if a large holder wanted to sell, they wouldn't do it on Comex, where it would just crash the price they're trying to get. So condition C is also locked. Now, let's run through these scenarios. Scenario 1, Comex drops to $68. This can happen easily in a thin market. A fund liquidates, an algorithm triggers a sell program, and the price plunges from 72 to 68. Meanwhile, Shanghai is sitting at 80. Boom, instant $12 gap. The arbitrage bots will go crazy trying to buy Comex, but the damage is done. The $12 gap has been printed on the charts. Scenario 2, Comex slowly rises to 75, but Shanghai reprices to 87. As Comex grinds higher, industrial buyers in China see it as confirmation of a shortage. They start bidding more aggressively to secure their supply, pushing the Shanghai price to 82, then 85, then 87. You end up with Comex at 75 and Shanghai at 87. That's your $12 gap. Different mechanism, same result. Scenario 3. Comex stays flat while Shanghai explodes. Imagine Comex just drifts sideways at $72, but an unexpected surge in industrial demand hits Shanghai. A new solar contract, a big battery order. The price in China jumps to 84. Again, a $12 gap. Any of these scenarios can play out during Ghost Week because the usual market breaks are gone. There's no adult supervision. It's just algorithms and industrial buyers fighting over scarce metal in a dangerously thin market. But the gap isn't just a number, it's a signal. A $12 gap tells the world that the paper market has failed, that something is fundamentally broken. And once that signal goes out, behavior changes. Patient buyers become frantic. Skeptical speculators become believers. The gap becomes self-reinforcing, not through manipulation, but through simple mathematics. Some might say this is impossible, that the exchange will intervene. But intervention during Ghost Week is incredibly difficult. The decision makers are on vacation. And what would they even do? Raise margins? That just forces more selling into a thin market, making the gap worse. Halt trading? That just pushes everyone to Shanghai and proves Comex is broken. The only real solution is more physical silver, but that takes weeks to ship. And it's not arriving next week. In part 4, the final chapter, I'm going to give you the specific warnings and signals to watch for. Understanding this is one thing, surviving it is another. Stay with me, we're finishing with the survival guide. We've reached the conclusion. We've covered Shanghai at $80, the Ghost Week amplifier, and the clear path to a $12 gap. Now, it's time for the practical framework for navigating the next 7 days. This is arguably the most dangerous trading week of the year, and most people don't realize it until it's too late. Here is the single most important warning. Do not use high leverage this week. Ghost Week is famous for creating what we call killer wicks. These are 1-second price spikes that exist only to hit your stops and then immediately reverse. You can be 100% right on the big picture and still get wiped out by a random algorithm glitch. I've seen it happen. A trader is long silver, believes in the thesis, and uses 10 times leverage. A rogue algo dumps the price $3 in 30 seconds. His stop is hit, he's liquidated. 5 minutes later, the price is right back where it started. He was right, but he's out of the game with a huge loss. This is not the week for clever trading. It's a week for survival. If you're holding physical silver, you're fine. Your metal can't be liquidated or stopped out, you just wait. But if you're trading futures, options, or leveraged ETFs, you have to be extremely careful. Reduce your position size, widen your stops, or just sit on the sidelines until January. Now, for the 5 real-time signals to watch for. If these align, it's confirmation that the gap is opening and the market is screaming scarcity. Signal 1, Shanghai holds above $80. This is the foundation. If Shanghai maintains that level, the physical demand is real and the floor is set. Signal 2, paper prices dip, but physical premiums rise. Watch what dealers are charging for coins and bars. If the paper price is 72, but you have to pay 85 for a coin in your hand, that's a $13 premium. It tells you the physical market does not believe the paper price. Signal 3, delivery times extend. Check dealer websites. If shipping times go from 2 weeks to 6 weeks, or items flip from in stock to pre-order, that's a form of rationing. It's a leading indicator of physical scarcity. Signal 4, vault withdrawals continue. The Shanghai Futures Exchange reports vault data weekly. If we see another large withdrawal, it confirms that industrial users are taking physical delivery because they don't trust the paper market. And Signal 5, the market opens with gaps, not smooth candles. If Shanghai opens $2 higher than it closed, that's a liquidity vacuum. It's a sign that buyers are overwhelming sellers overnight. Multiple gap openings during Ghost Week confirm that thin liquidity is amplifying every move. If these 5 signals align, the market is telling you the shortage is real and the path to a $12 gap is active. So what happens if it hits? First, a credibility crisis for Comex. It can no longer claim to set the global price. Second, a forced repricing. At some point, Comex has to violently gap higher to catch up, triggering a cascade of short covering. And third, system stress. Questions will arise about whether the vaults can actually deliver the metal, leading to a run on the exchange. This is the sequence of events we're watching for. Have you heard of Ghost Week? It's what we call the thinnest trading week of the year, right around the holidays. And this year, something's happening that you need to pay attention to, especially if you're involved in commodities, specifically silver. Right now, Shanghai is trading silver at $80. While the Comex in the West is stuck around 72. That's an $8 gap. And it's happening during the quietest, least liquid time of the year. This isn't just a headline, it's a huge signal. The nightmare scenario for the paper silver market isn't just that the price rises, it's that it rises in a way that exposes a critical weakness, the inability to deliver physical metal. When the price in one major market, like Shanghai, shoots up because of real physical demand, it starts pulling metal out of vaults in other markets, like those tied to Comex. This process drains the vaults, which then validates the very shortage that caused the price spike in the first place. It creates a feedback loop. The shortage gets worse, the price gap widens, more metal is drained, and the whole cycle accelerates. So here's the bottom line for what we're calling Ghost Week. While everyone in the West is looking at frozen charts and enjoying the holiday quiet, the real market, the physical market, is already screaming shortage. That $80 price in Shanghai isn't just a number, it's a signal that liquidity is vanishing, physical demand is in the driver's seat, and the gap between paper promises and physical reality is widening. And when this happens, markets don't just drift upwards, they jump. Ghost Week isn't calm, it's the eerie silence right before a major impact. And that impact could arrive as a $12 arbitrage gap, a gap so large it would force the entire commodity complex to reevaluate and reprice everything. Think about that. If you are positioned in physical silver, you're on the right side of this equation. Your metal is real, your position is secure, all you really need is patience. But if you're playing in the paper markets, using leverage, trying to be clever and time every little dip and peak, you need to understand the immense risk you're facing. Ghost Week has a way of destroying cleverness. It rewards patience and solid positioning. So what does this mean for you right now? It means it's time to be cautious. Consider reducing your exposure, widening your stop losses, or taking some profits off the table if you have them. Or maybe just step aside and watch, because the next 7 days are going to be a real-time test. They will either validate this whole thesis or prove it wrong, and we'll know very, very quickly. There are a few key signals we'll be tracking. Will Shanghai hold that $80 plus level? Will the Comex manage to close that price gap? Will physical premiums remain high? Will the vault withdrawals continue at this pace? These signals will tell the true story. That's why you should subscribe, because our next videos won't be about analysis or speculation. They'll be the scoreboard. We'll be tracking the Shanghai Open every single day. We will monitor that price gap in real time. We'll watch the premiums. We'll report the vault data as it comes in. And if that $12 gap actually happens, we'll know exactly what it means. It won't be speculation anymore. It will be confirmation. Confirmation that Ghost Week lived up to its name, that thin liquidity created an explosive move, that the physical market overwhelmed the paper market, and that the arbitrage gap that seemed impossible just a few weeks ago became inevitable. Now, this isn't about spreading fear or hype. This is a straightforward observation of market structure under extreme stress. The facts are simple. Shanghai is at $80. Comex is at $72. The gap is $8. We are now entering the single thinnest liquidity week of the entire year. Meanwhile, industrial demand for silver doesn't take a holiday, it's constant. The West's capacity to respond with traders and institutions offline is at a minimum. The conditions for this price gap to expand are, frankly, perfect. So, Merry Christmas and welcome to Ghost Week. The week where gaps don't close, they explode. The week where the normal rules just don't apply. The week where a $12 arbitrage gap stops sounding crazy and starts looking like simple mathematics. You need to watch this closely, position yourself carefully, and prepare for the market to move in ways that don't make any sense on a paper chart, but make perfect sense in the physical world. Because when you remove the human traders and leave the algorithms to run wild, when you strip out all the liquidity and leave only the volatility, when you remove the West's ability to react and leave Shanghai firmly in the lead, you don't get stability, you get chaos. And chaos creates incredible opportunities for those who understand what's happening, while it absolutely destroys those who don't. Don't be the one who gets destroyed. Be the one who was positioned correctly before Ghost Week even began. These next 7 days will be the ultimate test. They will determine who truly understood the market and who just thought they did. Thanks for watching, and I'll see you in the next update.